All right, today, Kevin Keuchler of MEP Mortgage and I are going to break down a buy down, a rate buy down. It's a temporary rate buy down. A lot of times, a lot of agents, a lot of consumers have heard of this, and they've only thought of it from a perspective of a seller funded buy down of the rate. We're going to go over all that on this video, share some amazing information with you on why this is a great opportunity for anyone in the market right now that's not happy with the rates, not happy with the prices, not happy with the monthly payment that's coming out at the end to get what you want right now and prepare and be in that house so that in the future, if rates start to drop, you can take advantage of that while in your home instead of coming to the market when that happens. So we talk about buy now, buy later all the time. This is a great way to buy now and get the benefits of the future right now. Save yourself a bunch of money on a monthly payment, give you a lot of tax benefits. So we're going to go over all that right now with Kevin. Kevin's an amazing mortgage lender, and he's brought me this information so that we could look at it from a spreadsheet perspective because I'm a spreadsheet guy. I want to see the numbers on paper. A lot of you out there are the same way. So we're going to break this down and what this looks like. This can be, before we get too far into it, this can be buyer funded with Kevin's company. And Kevin, I'll ask you to introduce yourself in a second here too. But this can be buyer funded, could be seller funded. You can have a combination of the both if you ask for seller closing cost credit. We can talk about that offline if you think this might work for you. My name is Tracy Barber. I run a team called the Lux Group at Real Broker. We'd be happy to chat with you anytime. My information will be in the YouTube video below. But Kevin, why don't you introduce yourself and then we'll get this going.
Sure. Kevin Keuchler. I've been a loan originator in the Boston area for the last 22 years.
Awesome.
And I live in Needham and love what I do.
Awesome. Kevin, I'll put your information in the YouTube video in the description as well in case anybody wants to get in touch with you. But let's break this down. So we looked at a scenario because I am all about finding better solutions for clients. We all are going through the same struggle right now. We don't love the prices in Massachusetts, and if you're watching outside of Massachusetts, you may be in the same situation, feeling like the prices just aren't in a line with where you'd like them to be, and certainly the rates aren't either, and it's creating this friction point where buyers aren't in love with buying. Sellers still aren't happy with the prices they're getting because they're never happy. Let's just face it. If they could always keep it going up and up and up, they would. But the real reality of the situation is buyers are feeling it's not very affordable to own a home right now. So we've been looking at this option for the buy down for a while. But we've recently started looking at this from a standpoint of even if the buyer has to self-fund this in order to get the deal done, because we know that closing costs from the seller can create a place where you're not really competitive with your offers. Well, let's talk about buy down from a self-funded perspective, and especially in a scenario where a buyer could put 10% down, but maybe they only want to put 5% down. And my question to Kevin last week was, well, what if instead of the buyer putting 10% down, what if they take part of that money, do a 5% down loan and self-fund the buy down of the rate temporarily? And what does that look like on paper? And Kevin came back with all these numbers. So thank you, Kevin, for doing that. We're going to run the scenario based on $600,000. So Kevin, why don't you walk us through the numbers that are on my screen right now, and we'll kind of talk about the scenario.
Okay, sure. And just a brief definition of temporary buy down. Basically, it's extra points. 1 point is 1% of your loan amount that you pay to lower your interest rate. And a lot of your listeners have heard of points to lower your interest rate for 30 years on a 30-year mortgage. So traditionally, you could pay 2 points, lower your rate by half a point, and you get that benefit over 3 years. But a half a point savings, you might be lowering your rate from 6.5 down to 6%. That's good, but might not be dramatic enough for some people. You
Okay.
could also alternatively take 2 points and buy what we're talking about, a temporary buy down, where you get all of the benefit in, say, 3 years. And that's what you're looking at here.
That's true because I've heard of a permanent buy down a lot. There's not a lot of talk about the temporary or the short term buy down. We're going to talk about why that's important. Before you jump into the numbers too, Kevin, you did want to clarify to me that The rates that we're showing on the screen are APR, so they're adjusted based on mortgage insurance, correct?
Yes.
And we are in the first week of April. So if you're watching this video, I mean, this is fluctuating. Things are fluctuating on a weekly basis. Actually, Kevin, right before we started hitting record, Kevin said, "Wow, they're going up a little bit this morning," because obviously the market is very volatile right now. But we have to base this on something. So this was at the numbers as of Friday, um, April 5th or 4th or whatever it was, and we're just going to look at the scenario because we want to show you what the difference is based on these numbers. So the numbers may be a little bit different when you contact us, but it's a starting point.
Right.
So Kevin,
So,
break down the numbers for us.
sure. So in this scenario, we're looking at, what is the difference between 10% down and 5% down, your first two columns. So with 10% down, you're paying quite a bit of money to drive your monthly payment down with a lower loan amount. So your payment during year one is just under $3,500 a month. With 5% down, your middle column, and this includes PMI also, as you mentioned, you're knocking about $30,000 off of your down payment. So that's savings. However, you're taking a hit. Your monthly payment's going up by $250 per month. And for a lot of people in this market, as you said, you've already got a higher rate, you've got a payment that's pretty high, and you're making it higher. So can we have the best of both worlds? And that's where the 2-1 buy down comes in. So that's your third column. You're putting only 5% down. So you're saving $30,000. You're keeping that in your pocket. And you're actually lowering your monthly payment by more than $400 a month for the first year. And over $100 a month, again, compared to the 10% down scenario during the second year. So substantial savings, and the upfront payment for that is about $13,000. So your net out-of-pocket savings between comparing the 10% down to the 2-1 buy down is still about $17,000. So net, you've dramatically lowered your monthly payment for the first 2 years compared to 10% down, and you've kept $17,000 in your pocket.
Yeah, that's a huge benefit. So, and where we're looking at this $42,000 down at closing versus 30,000, that's inclusive of the cost to purchase that buy down. So I just want to make
Yes.
that clear. That's the difference is you're instead of putting $60,000 down, you're putting $42,000. So you're keeping $17,000 more in your pocket. You're getting a much lower rate, and you're getting into that home at the rate, that might be more comfortable to you, especially if you've got a career that's scaling every year. You're just getting started in the professional world, and your income will go up. And or what a lot of us are really betting on, and I believe that this will be true. Every indicator out there is that the rates will go down in the next couple of years. It'll give you an opportunity at the lower payment to get in now at a lower payment and refinance when Kevin calls you and says, now's the time. Kevin, you told me in the fall when everybody was rate shopping last year, what did you tell me around October? Do you remember?
I don't.
It's everyone that you'd put in a loan in the earlier part of the year was already refinanced.
Oh, right. Yeah, I
So
had a
we hit a low
client.
in like what, September?
Yeah, I had a client who bought in late 2023 when rates were at their peak. They were just under 8%. I don't think they had a bidding war because rates were so high there it scared some of the buyers out of the market. And then they were able to refinance at 6% last year.
Which is still lower than right now. So,
Yeah.
that'll be the conversation between you and Kevin down the road if you do something like this. And you're just like, okay, when's going to be the right time to refinance? We don't know that yet. But we do believe that there will be the opportunity to get into that lower payment in the future. Here's the other aspect of it that not many people think of is I have this conversation with buyers all the time about the tax benefits of owning a home. So I use very broad analogies because I'm not a tax accountant, and I always advise you talk to your tax accountant to get the specifics. I don't know what tax bracket you're in, but I use this scenario. If in the case of any of these loans, let's take the buy down. You're paying because you're at a lower interest rate, you've bought down your rate, you're not going to pay as much interest in your first year. But I've calculated out, and on this one, it's about $25,000 in interest on your first on basically your first 3 years. So that's a lot of actually no, that's per year. I'm sorry, that's per year. So $25,000 per year. That first year you're paying 25,000 on interest. If you're in a 25% tax bracket, that's over $6,000 in tax savings. And what I usually get from a comment from clients is, well, that's great, but I'm not going to see that benefit until next April. If I buy right now, I'm not going to see that until next April. It just, my income, the taxes, withholdings come out, and then next year I might get a refund, I might not. And if this is added to it, then obviously I could get a much bigger refund next year, but I'm not going to have that money until then. So this isn't going to benefit me for a while. That's where the rate buy down comes in my opinion, in a very nice fashion. You're getting the lower payment in the first year. The tax benefits will hit your pockets in the second year and the third year and really create an opportunity for you to really save. And the other thing that Kevin mentioned, which obviously, again, we're disclosing that you want to talk to your accountant about this, but the buy down, you can apply that to your tax credits as well, right, Kevin?
Yes, it's technically points,
It's point.
and when you're buying a home, points are, and again, I'm not an accountant either, but for most people, points are also tax deductible.
Yeah. So where I'm effectively telling you what your net per month is after tax benefits, in this scenario, your payment would net around $2,500, not including taxes and insurance. That's not including the points that you can write off. That's not including your property taxes. And if you're self-employed, there's a lot of write-offs that you have for the self-employed use of your home. There's some on the rental side as well, but I'm just talking overall benefits of owning a property. When it comes to both the benefits of owning appreciation and tax write-offs, there's a lot more in home ownership. So keep those things in mind because, effectively, let's look at this scenario. $2,400 net to you, even if that's not including taxes and insurance, it's probably about equal to what you would save in taxes as what you'd be paying for your property taxes and insurance. So effectively on a $600,000 home, yes, your mortgage payment is probably going to be 20, let's say 3,000 here, plus let's call it $700 on taxes and insurance for your property taxes and insurance. Call that $3,600. Effectively, end of the year, it's going to be less than $3,000. I mean, rents now. I mean, I just saw recently in Worcester that 3 bedrooms, 4 bedrooms are getting up towards $3,000 a month, and for really nice rentals, they're over $3,000 a month. So, I mean, people get sticker shock. They get sticker shock with, oh my God, the price of a single family home in Worcester. But when you start to use some scenarios like this, it becomes a lot more, um, enticing on why you should be considering home ownership and why maybe not wait for the rates to get better. One of my thoughts is, we've got such a shortage of homes right now. If rates all of a sudden dropped into the fives, Kevin, what do you think is going to happen?
So, and I saw this last fall. I saw buyers flooding into the market when rates dropped into the fives. So, the buyers who had already purchased, so people sitting on homes, as I mentioned previously, they were refinancing. Meanwhile, my clients who hadn't purchased yet were stuck with really intense competition, bidding on homes, trying to get them.
Right. What do you roughly have a number off the top of your head on what a $50,000 difference in sale price versus a 1% drop in interest rates would net out?
Off the top of my head, uh, I think that the 1% drop in rates is, probably larger. You're going to
Right.
get a bigger benefit.
Right. So that's a scenario everyone has to consider is do I wait?
Yeah.
It's come down.
Yep.
Say they come down a 1% and we get into the fives again, and then the prices are $50,000 higher. You are certainly going to be in a better scenario if you bought now, got used a buy down to get into that better rate temporarily. And then yes, you're 4.64 now for the first year. Let's say the rates come down in the fives by next year. You refinance then, a slightly higher payment, but certainly better than what you would have been paying if you were at the 6.49 right now.
Right, right.
Any other thoughts you
And
have on that, on like why someone really should be considering this?
yeah, you were talking about that $50,000 increase in price that you might see if you wait until rates are down to buy. The other thing to think about is you're also $50,000 behind on principal. And one hidden benefit of refinancing over time is that the more equity that you have, so you're looking at, what is the differential between your loan amount and the value of your house. People with lower loan amounts relative to the same value, they get lower rates. So standard rates drop um, based on the amount of equity that you have. So if you're paying $50,000 more, you're $50,000 behind the net equity eight ball, and you won't be able to get rates quite as low when you get around to refinancing.
Right, makes sense. Makes sense. So, overall, like this is a great scenario. Now, here's the other aspect of it while I'm pulling up because I did want to run these numbers for people just so they see the difference in actual numbers. If they're doing 5% down at a what rates are right now versus, what they might be next year with a higher sale price. Now this does not have to be completely buyer paid. So let's say you want to run with this program. Yeah, I want to do a temp rate buy down. I want to do a 2-1, and it's going to cost roughly 13,000 on or just a little bit less on a $600,000 purchase. But I don't want to completely self-fund it. If you run into a scenario where, let's say, it's not a highly competitive bidding situation, you can ask for seller closing cost credits, and you can apply those and still be self-funding the rate buy down. Correct, Kevin?
Yes, you can split it up that way.
So you could ask for 6,000 from the seller. Now the seller's funding some of it, you're funding the rest of it, or you're funding all of it, but the seller's because you still have closing costs involved with your loan. You have rate buy down is one aspect, that your closing costs are another. You can ask for
Yes.
seller paid closing costs and self-fund your buy down or a combination of both. Do you see a scenario, Kevin, where someone could use this on an FHA loan as well, on a 3.5% down loan where they might have like 5.5% total they could put down, but they do an FHA instead? What are your
Yeah, they could, but the FHA loans aren't really designed for buy downs right now because you already have substantial closing costs
Gotcha.
with those in the form of that upfront mortgage insurance payment. So yeah, that's it. I don't think it makes as much sense with an FHA
Okay.
loan.
All right, good to know. I figured I'd ask the question. Let's look right now, quick. I just ran 600,000, 5% down, 6.64. It came out at 36.55. If the price goes up and the rate goes down by a percent, let's say it goes down to 5.64, but you're going to have to pay $50,000 more for that property. Let's see the difference. 36.54 versus 35.74. So you might be saving a little bit, but
Yeah.
if you're in a highly competitive situation, this is what comes back into play. Everything that I'm seeing in the last 3 years, bidding wars, inspection waivers, having to show a lot more money or putting a higher down payment to even be considered for a property. Um, Escalation clauses. It just goes on and on and on. So literally, I tell people all the time, like if you're shopping for a loan, you really would prefer to have gotten a better rate or wait for a better rate, but stay in the market. Stay in the market, look for homes. If you see a home you like, buy it now. Because there's a scenario where in the future you come into the market with everyone else and you might see 20 homes you like that you just don't win on the bid. So I love buying right now from a buyer's perspective. Buy now. I hate I hate the slogan that people came up with last year. Uh, uh, what is it? Date the rate, marry the home. Marry the home, date the rate,
right?
whatever. Either way you put it. I hate that analogy because it's not a smart business decision to just throw all caution to the wind and buy the home and then just you're going to automatically in a year be able to refinance. There's no guarantees with that, Kevin, right? There is no
Right.
guarantees. Right? So you have to make smart decisions. You have to make decisions you can live with. But at least with like I see and hear people getting into arms. Are you doing many arms right now?
I am not because of the uncertainty in the markets right now. The ARM rates are not that much lower than fixed rates,
Right.
so
And
you
even
might as
even
well
if
get a
they were,
fixed
I
rate.
don't love those products. I mean, to me, I'm looking at a product like this, use a temp rate buy down. It gets me a good mortgage payment the first year. My tax savings will catch up to it in the second year. If I get six, seven, $8,000 more in my refund check, it's money that I can use to pay a little higher payment in the second year. And then you're back to the 6.64 in year three,
Right. Yep.
unless the opportunity comes up to refinance. If it doesn't, can you live with that year three payment? Ask yourself that question. And if you can, you're good worst case scenario. Best case scenario, you get an opportunity to hopefully refinance in the next year at a lower rate that's going to be a permanent 30-year rate. And just so that people know, in year three, once it goes back, once the 2-1 is done, it goes back to that 30-year payment. That doesn't change.
Correct.
So, and the other scenario where people are like, well, I'll just do a permanent rate buyout. What was the period of time, Kevin, you said if you're going to stay longer than this, do it, maybe consider it, but if not, don't consider it. What was that?
Yeah. So with the permanent rate buy down, you're getting a somewhat lower rate, about a 0.5% for the duration of the 30 years, and the break even point or the permanent buy down becomes better than the 2-1 buy down around year five.
Okay, awesome. Awesome.
Yep.
And then you're kind of, in my opinion, if you're doing that, you're kind of betting on the rates not.
You're betting on you're not going to refinance for 5 years. You're not going to sell your house for 5 years. So that's really the bet.
And you're okay watching the rates maybe sometime going into the fives and not considering a refinance. Because at that point, you
Right.
you might you paid more to get that slightly lower rate, and now you're going to refinance. And that doesn't make any sense, really. Um,
Right, right. I call that rate remorse. People buy their rates down, and then 6 months later, rates go down to that level anyway without
yeah.
points.
Here's
Yeah.
one other point I think we missed before we close this out was if you refinance, let's say you refinance in 6 months, what happens with the money that you paid up front for that buy down?
So with the 2-1 temporary rate buy down, you get all the money that you haven't used, you get it back. So when you refinance, we reduce your principal balance. So it goes right to you.
So theoretically, if all of a sudden we get a market that's saying let's lower the rates because we'd like to see it because we're like, okay, well, I hear all these things every day like the 10 years down to 4% or whatever, like a lot of that's over my head, but usually in the past that those are indicators that at some point the mortgage rates come down. Is if in 4 months you've done the temp rate buy down and you've got into that lower payment and you're paying that lower payment, and then in 4 months the rates reach a number that would be close to the second year number, refinance, right? And then
Right, right.
take that money that you put, maybe there's 8,000 left of the 12,000 or 7 or 9, whatever it is. You either get refunded that or do you put that towards your mortgage balance or you choose?
We automatically subtract it from your principal balance.
Oh, okay.
So so you get a lower mortgage.
So you get a lower mortgage, lower
Yeah.
principal, and you're refinancing and still get
Yes,
all the benefits of the interest every year you have that mortgage.
correct.
Awesome. Well, all right, Kevin, how do people get a hold of you if they want to give you a call and talk to you about this more? Because here's the first thing I tell all buyers I work with. Have a conversation with a qualified loan professional early in your buying process. Don't be afraid of the pre-approval process. They're not going to say, "Well, I can't talk to you until you submit a pre-approval." A great loan officer like Kevin will have a conversation with you to figure out when that right step might be. But I hear buyers all the time. They're scared to talk to a loan officer because they're kind of scared of the pre-approval process, which is rightfully so. It's a scary process. So, but I think they should have a conversation early on, talk about strategies like this, look at the scenarios. How do they get a hold of you to have that conversation with you?
The best way is just to call my mobile number, 617-827-0297.
Awesome. Any leaving comments or suggestions?
Um, I would say entering this conversation, you want to consider both the temporary buy downs and the permanent buy downs because, sometimes it, the temporary buy downs aren't always the answer. I think right now they are for more people, but it's also good to take a strategic look at other options as well.
Awesome. Awesome. Well, catch us on the next video. Next video, we're going to talk about in the next few days, will drop. We're going to talk about how to make yourself look like a cash buyer, how to basically give the seller a guarantee that you can close on the property or the company that backs this program will close on it and guarantee the seller gets the closing, making you a much stronger buyer when you're up against a bunch of other offers. So stay tuned for that video and we'll drop that in the next few days. Thanks, Kevin, and we'll see you on the next one.
Thanks, Tracy. Yep.